Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, today we're going to be taking a look at Bitcoin. We're going to have a look at the long-term behavior here on the chart on the BLX and update our long-term counts, which won't take very long. They're the same as they have been for months and months. Then we're going to come in and have a look at the shorter time frame. Now, the shorter time frame has gotten pretty, what's the word, ambiguous. I'm still bullish overall, but there is a multitude of ways we can interpret a bullish count off of the low. We don't have the same issue with a bearish count. That's quite simple. And so we've been going back and forth on the Patreon, on the Discord. I've been discussing it in multiple live streams, and I'm still none the wiser, really, if I'm absolutely honest, on the smaller time frame. I'm still bullish, but we'll talk about various counts. We won't go into all of them. If you're interested in seeing them in more detail, I would advise that you follow the link in the description box of this video below, head over to the Patreon and sign up. Tier 2 is the most popular tier for 10 quid a month. You'll get access to those weekly live streams. I normally do 2 a week for 2 hours at a time. Anything you want to see you can request via the Discord. Crypto, equities, commodities, whatever you like, I'll take a look at it for you. Now, also on another note, £15 a month secures you everything in Tier 2, which is the monthly live streams, access to all the educational videos. Plus, you also get access to the stock rating system and dividend calendar, which I've literally just loaded up for May. This is what you would see as a prospective customer. Where you've got the Excel folder, a couple of PDF files, and explanation explaining how it works. But I think we've got over 60 stocks listed this month, and almost 40 ex-divs, or high 30s ex-divs, I think. So a lot of, for those of you who are out there who are more interested in investing, long-term value investing, that might be just a thing you're interested in. If you're more of a trader and you want to learn Elliott Wave from scratch, we have a video series where you can learn Elliott Wave. There's a multitude trading videos on here as well, and then plus all that other educational content and weekly live streams. So if you want more coverage of the assets you're interested in, joining the Patreon today is the best way to get it. So now let's get back to the video, and we'll start here on the BLX looking at the long term. So the long term count is completely unchanged, and what we're going to do is just remove the primary for a moment, and we're just going to look at some classical analysis first. So I pointed out several months ago before Christmas that we were looking at the conditions we've seen in prior bear market lows, where we've gone from overbought to oversold on a weekly time frame, have bottomed in deeply oversold conditions on the weekly time frame like we've done here, and then had a first swing back up into oversold conditions like we saw here. We've done it again here, and essentially we've got every reason to think that we may have bottomed. Okay, now another thing I pointed out also on that video was when we come out to the monthly time frame. We did the exact same on a monthly time frame. We've reached new, in fact each time we bottom, as you can see over these RSI readings, these lows occur lower than the prior lows. So we've reached another extreme condition on the monthly RSI as well. And then when we look at the MACD on the monthly time frame, as I pointed out before, we have this huge bear market, bearish momentum, basically cooling off, and now looking to cross back over signal through the MACD through the signal, and to move back into green and back above the zero bound on the monthly time frame. Eventually, now we can stretch this thing out and see how prior bear market here, at the peak of January 2018 down to the trough of December, January 2019, and then gradually back out into the first wave up and back into COVID, and then the big third wave up here, and then the divergence between the fourth, the third and the fifth at the coming into November, and then from there down all the way into this bear market. And we can see how, if we go all the way back to the prior bear market, looking at the MACD on the monthly time frame, we can see the peak here in November 13, and then down into the trough of December to January 15, and then into the 2017 swing. So with that crossover below the zero band, back into positive territory. And now we're looking to do the same here. Essentially, we're looking to get that crossover completion at the end of this big bearish phase, and then another bullish move higher. So a break of the OBV on the downward trend of the lower lows and lower highs here we've seen on the monthly time frame as well. So we've got a lot of bullish signals. On the monthly time frame, we've moved below the 60 exponential moving average, which we've seen here. This was tested with a breach below it, but it was not a candle body below it, but we breached it again in the bottom of COVID, and this time we swung below it and now have traded back above it, back tested it and moved back up. So all of these things together give us the impression that we've done plenty to have bottomed, okay, and therefore our count over the long term supports that thesis, supports that idea. So let's just bring that up as a reminder. We're talking about a series of wave twos as sharp corrections over time. Now there's a video on my YouTube channel going back to summer last year where I covered this count in detail. Nothing's changed long term, so if you really want an in-depth view of it, you can go back and watch that. But essentially, if we look at the corrective forms we've been dealt, we've had a series of zigzags or double zigzags which are sharp corrections, and they fit, given the wave form, the expected severity of a sharp correction in the wave 2 position. So what do I mean by that? What I mean is how bloody deep it is, essentially. So if we look at the depth of these corrections, we get a 86% decline here in this super cycle wave 2, I'm calling it. We get an 84% decline here in the cycle wave degree. We get a 77% decline here at primary degree. So they are less severe, they aren't as bad as their prior bear market equivalents. I have no doubt, given the level of participation within this latest wave degree that we've had from the public, that it probably feels pretty bad to be down 77%, but I assure you it has been worse, having gone through this one myself and having come out of into crypto off the back of this one back in 2015 to 16, so I know what it's like to go through these things. If we go back even deeper into a smaller wave degree at a wave 2 sharp correction as well, we get a massive 93%. This is the bear market of 2011 into late 2011, so basically a year we had here, and this was a 93% decline. So 93, 86, 84, 77. So they're getting smaller and less severe, but they're remaining sharp corrections. So this is still my primary count. Now, while we're here, let's talk about the bearish count, because we have to have an alternate, and we don't just, abandon any idea of there being a bearish count. There is. The alternative idea is that we ignore the lack of alternation between these sharp corrections, and we ignore the lack of alternation in terms of new price extremes being expected or increased length of time within a sideways correction, and we simply go with a simple 5-wave count to the high. Okay, and that brings us into the high of November 21, and this gives us a larger wave degree correction which is now underway. So a W into an X into a Y. Okay, so, and this is not the primary, but this is the alternate. There's a lot wrong with this, but the primary isn't perfect either, but I do prefer it over this. Essentially, we would have to buck the trend of the trends we've seen in the RSI on both weekly and monthly time frame in the past, the trends we've seen in market bottoms on the MACD, shift from bearish into bullish histogram behavior. That would have to be different. Everything would have to have changed at the recent high. Okay, so that's fine, that's possible, but I just think it's less likely. So if that's the case, we've done a zigzag into a flat into a zigzag, W, X, Y. Now on that premise, the longer term support targets we were looking at for months and months on end, which I haven't gotten rid of because they're still relevant, are still relevant today. So if we were to come back and have a look at our target fibs, and we were to have a look at, let me find where the hell I am, our support levels, major support levels. If we were to look at our demand zones, given our fixed range volume profiles here, where we've got our double point of control crossing over in all of this noise here, and if we were to look at our fib retracement, and I think we're going to have to find the one that's in linear. 89% retracement in linear is right here, deep wave 2 that would be. We also have the golden ratio in log here, bang on the 89, 61 to 65, 61.8 to 65, right in this demand zone, right in amongst all this volume, right in amongst all this support. And that is essentially still, excuse me, if we come down lower, that is essentially still the most likely place we are going to find support in amongst all of this. Okay, we've got an extension of W from X to Y at 1 to 1, and we've got an extension of A to B to C here. We've also got the 89% retracement for wave 2 and the golden zone retracement. We've got big demand in here, double point of control in here, and we've got horizontal support in here, and it all basically falls into a zone. I know it's looking a bit overlappy and messy, but it all falls into a zone between 8.5 grand and 12k. Alright, you could expect to find support anywhere in there. So if we break down and the primary count turns out to be wrong, and this is the alternate count and it's a longer term wave degree correction, that's where I would expect to find support. Okay, you will come into there, and there's no guarantees ever, but it's highly likely you'd find support in there. So that's the alternate bearish count. We're going to come down into all that noise, we're going to find support and move higher. In the meantime, with all the evidence we have that we've broken the downward trend, back tested it, and have springboarded off of it, given the RSI conditions, the MACD conditions, and everything else that we've experienced at this low, that's sufficient to say we have a sustainable low in place for the moment and believe we are moving higher. And that's the bullish count. And from this point, we've gone 1 into 2, or we've gone 1 into here, 2 to come, and we're moving higher. And we'll talk about that now on the smaller time frame. So we're going to leave this chart behind now. We're just going to come over and have a look at this one, which is the smaller time frame. Now, like I said, there is a multitude of ways of counting the move off of the low. So I think the thing I would prefer to do the most first would be to just look at the bearish count, okay? Because it's if we've got an explanation for it in the long term, we've got an explanation for it on the short term, okay, on the shorter time frame. And that's the idea that we've been working a flat this whole time of 3 waves to here, 3 waves to here, and then regardless of how you get it, you could go 1, 2, 3, 4, 5 for a C of A, B, C. You could go 1, 2, 3, 4, 5. Okay, take your pick. It's completely irrelevant how you got here. You got here at the C, you got up in 5, you've gone 3, 3, 5. Okay, and it's a flat pattern, and it's the X wave, and now we've got another zigzag down. That is the bearish count. And at the moment, I have to be absolutely honest with you, regardless of my own bullish bias and my preference for the bullish count, having put in a high here and had an impulse down, it is far easier as a trader to short this from here, even if it's A, B, C for the bullish count, or potentially 1, 2, 3, 4, 5, A, B, C for the bearish count. Yeah, the odds are on your side at the moment. Well, not the odds. Sorry, I shouldn't say the odds of you being right long term. What I should say is the ability to manage risk is far better here to short than it is to be long for the moment. Now, that doesn't mean that it's not going to go higher. It could. Okay, it's always a possibility. But we prefer, when the market comes into the lows and we get 5 up and 3 back to a higher low, we want to be long, because most people are bearish here, right? And after a significant move up, 5 down and 3 back, we want to be short as traders and want to be bearish, because most people are bullish at the highs here, you know. And that's just, I think if you spend a bit of time on social media, you'll see that quite clearly. So that's purely from the technical point of view. We have a high in place, we have a move down and a pull back. That means that we have a little margin of safety here, a margin of risk from where the price got to, about less than 4%, even from where it is now. It's still within 10% of the high. That's a much better position or potential entry with a stop in place for a short than it is for a long at this point. Now, it doesn't mean you're going to be right, it just means you're managing risk more wisely. Okay, so now let's have a talk about the bullish counts, and we've covered the bearish idea of how we get lower. Okay, we've topped out here as a C, we've gone 1, 2 back, we're going to come down 3, 4, 5, 8, so on and so forth. So if we're saying we can get 5 up here, then we can get 5 up here as an impulse, right? So there's a lot of ways of doing it. That's the problem at the moment. Here's my preference, and it's not a primary count for a bullish. Like, the primary is bullish, but I don't have a specific bullish count of how to get 5 up here that I approve of over all the others. I'm just in a bit of a state of flux at the moment, and my preferred count is that we have a high in place. Right, we have a high as a wave 1, and we are going to come back in 3 waves in an ABC to find a wave 2 before heading higher again in a wave 3. So we should be having a more significant correction now. We've been losing some momentum into these highs. The MACD has shown some bearish divergence. There isn't particularly particular strong divergence on the RSI on the daily time frame, and that therefore leads to there being several possible interpretations because of this structure being a bit ambiguous. But we are at a recent high. We've had what looks like a 5-way swing down and a move back up. You're in better position given the margin we've been talking about from the high percentage for a stop loss to be short or neutral than you are to be long here at the moment. That's if you're trading longer term. We've come off of the low, we're coming back in 3. If you just want another opportunity to accumulate and add to your stash, it will be coming within the next few weeks if this count is correct. That's the preference. We'll come back into my little STS zone between the 38.2 and the 61.8. Typical wave 2s being deeper, looking for the 50 to 61.8, but we see shallow 2s in crypto quite often, so we have to be prepared for a shallower correction. So that's the preferred count. 1, 2, 3, 4, 5. Now you might say, you've poo-pooed this, Tom, and said that you didn't like it because the relationship and the general structure of the count looks a bit dodgy. Well, I feel the same way still, but here's the thing. 4 alternates with 2 as it is the wild card of a triangle in the place as a sideways correction. No new price extreme, but functioning as a sideways correction relative to wave 2's sharp correction as a double zigzag. The 4 does not overlap the 1 and therefore it's perfectly legal. The 3 is not the longest wave, but it is not the shortest. The 3 is longer than the 5th. That's perfectly acceptable in an impulse. The 5th is shorter than the 3 is shorter than the 1. The 4 does not overlap the 1, so it is not a diagonal. It is an impulse, and it's just an extended wave 1. We have a wave 1 extension as opposed to the more typical wave 3 extension. Now the wave 1 did not extend within the 1 of the 1, it simply extended the wave 3 at minute degree within minor 1, creating this, rather extreme looking minor wave 1. All perfectly acceptable. Alright? Now that's the preferred count because I've got to pick something. But here are all the alternatives, right? If we're not going to count an extended wave 1, we can go for an extended wave 3 and go 1, 2, 3, very deep 4, test of the base channel, 5. And we can get an impulse like this. Now, you might say, well, overall, Tom, I think that's a better looking impulse. Well, maybe. Here's my issue with it. It's perfectly legal again. I'm not going to complain and say it's wrong. The 4 doesn't overlap the 1, so that's fine. The 3 is not the shortest, that's fine. But the wave 4 doesn't alternate at all with the wave 2. They're both sharp corrections, and 4 is extremely deep, coming to the golden ratio, which is pretty rare for a wave 4. But I can live with it. Right, so that's an alternative. It's just less likely, in my opinion. Alternatively, again, let's come down to the 4 hours so we can see a little bit more detail here. Alternatively, again, we're working on a wave 3 extension at minute degree within minor 3. So we've got minor 1, minor 2, minute 1, minute 2, minuet 1, minuet 2, and so on and so forth, and we'll work our way up in 3 of 3 of 3, and we will make new highs and continue from here. Okay, now what I've got here is length of minor wave 2 in time. It's this yellow line here. I would not expect the minute wave degree 2 to be longer than the minor wave 2 at this lesser degree. So it's either done or it's going to be done soon. But I would expect it to stay within the boundary of this line here. Alternatively, we've got... No, I don't like that at all now. I'm going to get rid of that one. And then we've got the idea of another way of looking at an extension. So same count, 1, 2, 3, 4, 5, 1. WXY 2 back test of the bearish trend. 1, A, B, C, 2, 1, 2, and off we go higher. Alright, so here's the problem with that being a flat, right, is currently running flat would prefer an expanded flat I wrote here. So what we've got is a free, what we've got here is a free 5, right, excuse the mess, but you see what I'm trying to point out. 3, 3, 5 with the C finishing before the A and the B extending beyond where the A began, this giving us a running flat. Flats are less common in wave 2 than sharps, but they do occur. Expanded flat structures are the most common to occur in that circumstance because they're the most common kind of flat. The running flat, where the C fails to extend beyond the A, is rarer. Running flats are quite rare, and for it to occur in the wave 2 position is very rare. So that strikes me as not something I can give really high probability to. So it all brings me back to the idea that the most probable idea, probable does not mean it is correct, it just means more probable, is that we have topped in a wave 1 and we're going to come back in a wave 2, and we could do that any number of ways. We could come down in a zigzag, back up in a zigzag, and down in 5. That could be possible. We get a big flat pattern. We could come down in 5, 3, 5 as a zigzag. Either way, when we look at the local support we've got down here, 25, 2, 1, 2, this prior high, this prior high, this little demand zone here, if we bring up our little demand and FRVPs, we can see we've got a little demand zone down here just above the 38.2. That's if we were to find support at these prior highs as well. We could come deeper into this little demand zone here. We've got lows here as well to consider between the 50 and the 61.8, and another horizontal support level at 21.473. Brings us time wise anywhere between the 23.6 and way longer. Depends on the kind of correction you get. It could be twice it could be the same length as the impulse, it could be twice the length of the impulse. This is 23% the length of the impulse. We've got 38.2, 50 and 618, all in this target box around the 50 to 61.8 retracement, Fibonacci retracement. So that's where we're likely to find support if we're coming down in 3. Now I could talk at greater length, or I could just wrap things up there, and I honestly feel I'm better off wrapping things up here than going on and on and on, because we've talked about the bearish possibility that it's just an X wave that's complete as a flat and now we're going to come down lower. If that's the case, we will take out the previous November low, which is our invalidation point for the bullish count at 15,479, and we will seek out new lows like we talked about in the long time frame between 8.5 grand and 12k into that massive support we have down there. Excuse me. In the meantime, for as long as we remain in an impulsive 5-3 move off of that November low, I'm going to remain bullish until proven otherwise. Now, we'll see what happens. If we lead down in a big, obvious, clear as day 5, I'm going to have a hard time, if it's very deep, convincing myself anymore that it's bullish, because given the length of space that we'll expect in a further move lower, we would run out of room to get a bottom. We would more likely be impulsing down in a more aggressive move, right? But if we come into here and find a whole bunch of support and bounce impulsively, that's just going to reaffirm my belief that overall it's bullish. And if we go higher in the meantime, we've got counts to explain that. Okay, I'm sorry it's so ambiguous, I'm sorry it's a bit confusing at the moment, but that's just the way the chart is sometimes. You don't always get a beautiful, clear 5-wave impulse followed by a beautiful, clear pullback. Sometimes it gets messy and difficult to explain, and this is one of those circumstances. But as I've stated many times before, if you've come down 50, 60, 70, 80% or whatever the hell, right, and you found support and you bounced higher in 5 and come back in 3, and you're nearer the lows than you are the highs, it makes way more sense to be bullish on the longer time frame than it does to be bearish. And as we've discussed as traders, once you come to a swing high move down in 5 and 3 back, it makes more sense to be bearish shorter term. So I'm going to leave it there, guys. Thank you very much for joining me. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as I mentioned earlier in the video, if you want to join the Patreon, follow the link in the description box below. Head over, have a read of it is, and feel free to sign up whenever you like and access all that great material. If you're not following me on Twitter yet, please do so, as I always put up a link to my videos on YouTube when they're new. So take care of yourselves, guys. I'll be back with you as soon as I can. All the best. Bye bye.